Right now, Hertz Global Holdings, ticker HTZ, is trading live at $6.55. That's a solid jump, up 0.37 or 5.90% this afternoon. And for most people casually glancing at their Fidelity mobile app or Robinhood app, they're seeing that 6% green arrow and probably shrugging. They're thinking, okay, a travel stock is having a good day. They are completely, fundamentally missing what is actually happening here. This 6% pop is not a good day. This is the aftershock of an earthquake. This is one of the most violent, painful short squeezes and institutional repricings we have seen all year. The expectation, baked into Wall Street consensus for a solid year, was that Hertz was a dead company walking, a failed experiment drowning in a sea of Tesla stock it couldn't get rid of. The reality is that this company just did the unthinkable. Just 3 days ago, it reported a profit, and not a small one, a massive, consensus-destroying 700% earnings surprise that has sent short sellers into a full-blown panic. Today's 6% move isn't a rally, it's the sound of a bear trap snapping shut. Look, let's get right to it. The general belief, the story that has defined Hertz for the past 2 years, has been one of unmitigated disaster. This is the company that emerged from bankruptcy and, in a fit of what many believed was pure hubris, announced a blockbuster deal to buy 100,000 Teslas. It was supposed to be a brilliant, forward-thinking pivot. They would have the most modern, in-demand EV fleet on the planet. Self-investing individuals piled in, believing they were getting in on the next great reopening play, a tech-forward travel giant. But the reality, as it unfolded in slow-motion horror, was a catastrophe. They bought these Tesla stock vehicles at the absolute peak of the market. Then Elon Musk slashed prices, vaporizing the residual value of Hertz's brand new fleet. Worse, they discovered that when renters crashed these EVs, the repair costs were astronomically higher than for a standard gas car. The entire strategy inverted. They were stuck with a fleet that was depreciating at a stunning rate and was incredibly expensive to maintain. This is what led us to the events of this year, the great EV fire sale. Hertz, in a humiliating public reversal, announced it was dumping its EV fleet, flooding the used car market with 20,000 Teslas and other models, often at huge losses, just to stop the bleeding. The stock, as you would expect, was annihilated. It became a pariah. It was a favorite of short sellers, a stock that most Fidelity wealth management advisors wouldn't touch with a 10-foot pole. Anyone using a sophisticated interactive broker's trading platform could see the short interest was high. The consensus estimate for their earnings this week on Tuesday, November 4th, was for another loss, somewhere between 2 and 7 cents per share. The expectation was for more pain, more losses, more confirmation that the company was broken. And then Tuesday morning happened. The company didn't just beat the estimate, it reported a positive adjusted earnings per share of 12 cents. This wasn't a rounding error. This wasn't an accounting trick. This was a swing from an expected loss to a massive profit. The market, which had priced this company for failure, was caught completely, totally, and painfully offside. The stock exploded, jumping over 40% in a single day. What you are seeing today, this 6% continuation, is the market's dawning realization that this wasn't a fluke. The company didn't just get lucky. When you read the earnings call, the reality underneath that headline profit is even more stunning. The company reported record-high fleet utilization of 84%. This means that while they were busy selling off the unprofitable EVs, they were renting out their remaining gas-powered cars at a record-breaking pace. Their cost control measures, the ones Wall Street analysts had dismissed, were actually working. Their strategy to build up their Hertz car sales retail division, the very channel they are using to profitably dispose of their non-EV fleet, is succeeding. This is a masterclass in expectation versus reality. The expectation was that Hertz was a hardware company, a dumb holder of depreciating metal assets, held hostage by the whims of Tesla stock pricing and the used car market. The reality that management is trying to sell and that the market is finally buying is that Hertz is a complex asset management company, a company built to buy, rent, and sell vehicles at a massive scale. And for the first time in 2 years, they've proven they can actually do it profitably. This 6% pop is the sound of institutional investors at their interactive brokers terminals reading the analyst reports that are being frantically rewritten and realizing that a stock they had valued at $4 is now posting positive earnings. The entire valuation model is broken. This is where online investing gets so dangerous and so exciting. For months, anyone using a SoFi Invest account or a Robinhood stock trading platform who tried to buy the dip in Hertz was incinerated. They were fighting the trend, fighting the narrative, and fighting the reality of the EV losses. But now the tables have turned 180 degrees. The short sellers, the ones who were making a killing, are now the ones being incinerated. This is not a stock for an automated, intelligent portfolio from a place like Schwab Intelligent Portfolios. Those systems are designed to avoid this exact kind of whiplash-inducing volatility. This is a stock for active, high-risk traders who are willing to read the 8K. This is an individual brokerage account, and it's not for the faint of heart. Let's be clear about what Hertz does, because the story got so lost in the EV noise. Hertz, along with its Dollar and Thrifty brands, is a foundational piece of the global travel infrastructure. They operate from thousands of airport and off-airport locations. Their core business is simple: buy cars, finance them with debt, rent them out, and then sell them into the used car market before they depreciate too much. The entire business lives and dies on 3 numbers: the price they pay for the car, fleet cost, the price they can rent it for, revenue per day, and the price they can sell it for, residual value. That disastrous EV bet broke the model because the residual values collapsed. The Q3 earnings report that is causing this rally shows that by aggressively managing their gas-powered fleet, they have fixed the model, at least for 1 quarter. This is a pivotal moment for this company, and I want to know what you think. Comment below. Was Hertz's giant Tesla purchase the single worst corporate decision of the last 5 years, or was it a brilliant idea that was just crushed by bad timing? Let me know your take in the comments. So, what is the path forward from here? How do you even analyze this stock now? The bull case, which seemed impossible just 1 week ago, is now the dominant narrative. The bulls will argue that this $6.55 price is still absurdly cheap for a company that is now profitable. They will say the EV unwind is almost complete, the non-core assets have been sold, and the company is now a lean, high-utilization rental machine. They will point to the $2.48 billion in revenue, which also beat expectations, as proof that travel demand is robust. They will be using their Fidelity brokerage accounts to buy this 6% pop, believing this is just the start of a multi-month re-rating that will take the stock back to double digits. They believe the worst is definitively over. The bear case, however, is not dead, it's just wounded. The bears will argue that this is a dead cat bounce, a massive, technically driven short squeeze on a single good quarter. They will point to the company's still massive debt load. They will argue that the used car market, while stable for now, is a huge risk. They will say that 1 quarter of 84% utilization is not a new trend, it's a one-time anomaly. They will argue that the company still has no long-term competitive advantages against rivals like Avis or the Nvidia stock-like technology of Turo. They are probably reloading their short positions through their interactive brokers account right now, betting that this rally will fade as the reality of their debt-laden balance sheet sets in. They'd argue this isn't a stock for a Fidelity IRA or a long-term investment. It's a trader's plaything. It's not a stable asset like Apple stock or a diversified Fidelity ETF. So as we watch Hertz Global climb another 6% to $6.55, you are not just watching a travel stock get a lift. You are watching the continuation of a market war. The expectation was for bankruptcy and failure, a narrative that had been set in stone by the company's disastrous EV strategy. The reality, as delivered in a stunning Q3 earnings report, was a surprise profit, record utilization, and a cost control plan that is actually working. The market in its entirety was wrong, and today we are all watching in real time the violent and chaotic price of that mistake being corrected. Disclaimer: this content is for informational purposes only.